Hey there, my name is Robert Reynolds, and I'm curious about something. Why is Warren Buffett's favorite metric the return on equity? In today's video, we're going to break down the return on equity. We're going to understand the pros and cons to using this metric, and then we're going to have a look at a practical example. How do we use it, and what does it tell us about the business in question? Let's get straight into it. We're going to break this down into 4 different segments. Segment number 1. It's always important to understand how these formulas are calculated. If we understand the calculations behind the formula, it'll be a lot easier to understand whether these higher or lower return on equities are actually sustainable over the medium to long term. Secondly, when we understand the equity component is the book value of shareholder equity, it's important to understand why one company commands a much higher book value versus another that commands a much lower book value. We're then going to move on and talk about some of the challenges with return on equity. And then we're going to talk about how a business would be able to improve its return on equity over the long term. If we can recognize how a business can improve its return on equity, maybe we might be able to forecast into the future company-specific growth rates that would be able to improve that return on equity. And then finally, we're going to look at how we can comp this against some of its peers in the same sector using ticker terminal. So let's get straight into it, and let's start off with the calculation. Return on equity is very simple. It's net income divided by shareholder equity. Everybody has a net worth individually, and every company has a net worth as well. Let's say you owned a property for $500,000 with a $250,000 mortgage against it, no other assets. Your net worth would be your property minus your loan, $250,000. That's your net worth. That's the book value of shareholder equity for an individual. Companies are exactly the same, and we can get this information from the balance sheet. When we look at the balance sheet, there's an asset segment, and then there's a liability segment. And you'll see on the balance sheet that the balance sheet needs to balance. So how do you go from the differences between the assets and the liabilities? Well, what's left over is the book value of shareholder equity. It's essentially the net worth of the company. This is what we own as investors. And that net worth will generate a specific return at some point in the future. So what we're doing is taking the income of the business, dividing it by the net worth of the business to get a specific percentage. That's a really good segue into the second part here. Why do certain businesses have a much higher book value, the book value of shareholder equity, relative to their price versus other businesses? And it's very simple. And you can see it right here. If you have a look at the current asset segment, which is this segment here of Facebook as an example, what you'll see is the current assets are $66.66 billion. First and foremost, what are current assets? They're assets that will be potentially already cash or converts into cash inside the next 12 months. It's very close to cash or closer to cash essentially. This includes cash itself, short-term investments, it includes receivables, and maybe some inventory. Inventory is a little bit sticky. I'm not a big fan of putting inventory in sort of accounts receivable simply because if we go into a recession, that inventory may not turn over. But anyway, that is a accounts receivable. In this case, we don't have any inventory. If we're looking at this, the asset segment is very, very, very liquid. Almost $48 billion is in cash. When we look at the current assets relative to its net property and plant, you can see that they're about equal. It's a very liquid business. It's a very asset-light business. And based on these assets here, the company is able to produce roughly $29 billion in 2021, $39 billion in net income in 2020, and $18 billion in 2019. Essentially, this here would be what's known as an asset-light business that just spits out cash flow. And when we look at the price to book value, what is the market being willing to pay for this? Well, it's being willing to pay 6.23 times its book value, 6.61 times its book value, and 7.04 times its book value in the years 2019, 2020, and 2021. So the market was willing to pay a higher price to book value for Facebook simply because it's an asset-light business that produces a lot of cash flow. On the flip side, we've got a company called Micron. And as you can see here from Micron, yes, they are quite liquid. They've got a lot of cash. You'll see that $6.6 billion is in inventory. And again, that's a little bit sticky. Outside of that, you have receivables and you've got cash and short-term investments. You've got roughly $14 billion liquid, which is fantastic for any business. However, when we look at the current assets relative to the net plant and property, you can see that it's roughly 90% higher, meaning this is an asset-heavy business. And we can recognize that when we have a look at the book value of shareholder equity. $39.9 billion is the book value of shareholder equity. 39 billion of the assets is essentially net property and plant. So this is more of an asset heavy business. We need an awful lot more capital expenditure invested into the business in order to generate income. If we have a look at the net property, plant and equipment in 2019, it's the end of fiscal year in March. In 2019 it was 31 billion. For that 31 billion, the company was able to generate 2.7 billion, generating a return on its equity of 6.9%. In 2020, 13.3%. In 2021, 17.4%. Micron is an asset-heavy business, and it's doing incredibly well, essentially, to generate those high returns on that equity, given that it's an asset-heavy, capital-intensive business. Given the differences in these business models, asset-light for Facebook, capital-intense for Micron, you can see there's a big difference in which investors are willing to pay for these businesses. 6 to 7 times for Facebook, 1.5 to 2 times for Micron. The reason why the market's willing to pay a higher multiple or a lower multiple is really got to do with how asset heavy or asset light the business is and how much cash those either light assets or heavy assets can produce. And that's very important to recognize when you're analyzing a business, because it might give you some sort of indication as to whether a business is overvalued or undervalued. Segment number 3, how do we recognize some of the problems associated with the return on equity? It's very simple. We're looking at total assets minus total liabilities to give us our shareholder equity. The challenge is it's indiscriminate as to what the assets are. As you can see here, we just take assets minus liabilities. Now, if you look a little bit more granularly into the asset segment, you'll see intangibles. Certain intangibles like intellectual property is perfectly fine. Other intangibles like goodwill is more erroneous. For those of you that don't know what goodwill is essentially, let's say there's a row of houses. There are 10 houses, and the average price of those houses is $100,000. That's the market value of those houses. Now, I want to buy a specific house, but the owner doesn't want to sell it for $100,000, so I offer $120,000. I pay a 20% premium on that property. Now, when I buy the property, I know full well that the demand for that is set at about $100,000. So what my balance sheet will look like in the asset segment, I'll have $100,000 here for net property and plant, and I'll have $20,000 in goodwill. That $20,000 doesn't really exist. And if the business went to zero, ultimately it went to bankruptcy, when you're trying to recover residual value for the business by selling all its assets, you can't recover goodwill. And so some businesses that might have made bad M&A deals might have very high goodwill. In this case, Facebook does have goodwill, and that's something that we need to consider because the net worth of the business might be impaired based on that goodwill figure. So it's very important to understand that although this is a great metric, there are some nuances such as goodwill that we really need to consider. If a business has a disproportionately high amount of goodwill, that's a bit of a challenge. So how can a business grow out its return on equity? Well, there's 2 different segments to this. Segment number 1, net income. Very simple. If you're in a growing market, stealing market share, and you're growing your revenue on the top line, that's fantastic. If you've got some element of economies of scale, you bring your cost of goods sold down, your net income will rise, your margins will grow. So the part of the equation is a good quality business that's growing long term with margin expansion. And if you've got some sort of insight into the growth rate of a business medium to long term, that solves for the net income side. The other way in which we could look at how the return on equity could improve is by looking at shareholder equity. If we're looking at shareholder equity, let's say a company makes $100 and it's over $1,000 of shareholder equity, it makes 10%. Now, if we are to reduce the equity to 500, the return on that would actually increase to 20%. So you would grow out your return on equity. So how could you do that? Well, if you look at the equity segment, there is a column called retained earnings. Most companies would have retained earnings if it's a good quality business. The company could use those retained earnings in order to pay a special or higher dividend if they already pay out a dividend. That would be one way to reduce the shareholder equity. Another way to reduce it would be to recognize goodwill, cancel that out to zero, and bring your assets down. It's not necessarily a way in which it would improve the business, it would just be more accounting tricks. The way in which you want to see return on equity grow would be to see net income essentially explode while managing that net worth of the business. Segment number 4. Let's have a look at an example. What we want to understand is whether a management team has been able to generate a strong return on equity, the net worth of the business, over a long period of time. Have they utilized their assets very well? Secondly, we want to have a look at it relative to its peers. Is there another more profitable business in the same industry or sector that might be asset heavy or asset light that's been able to generate a better return on its equity? So we're going to use Ticker Terminal. Ticker Terminal is probably the best resource that I've come across along my journey. Ticker Terminal has just about every single international stock you need, 15 years worth of data, and most of the calculations are already done. If you're interested, there's a link in the description. I believe there's a freemium model, and we'd really appreciate if you used our link. For this example, we're going to be looking at an industry that has a low book value. That is the banking sector, and we're going to be analyzing JP Morgan. There's a couple of things to keep on your mind as we go through this example. First thing is, this is a profitability metric. But secondly, if there's a disparity between the return on equity essentially, it's going to be very important to have a look at its book value. It's very important to look at the return on equity in tandem with the price in which we pay for that. And that's very important because one company that might have 10% for argument's sake in return on equity might be trading at 0.5 times its book value. And a company that might be trading at 15% return on equity might be trading at 1 times its book value. Based on the valuation, the first bank, provided everything checks out, is actually more profitable. So we need to look at the profitability and the price that we pay. Let's get straight into it and let's have a look at JP Morgan. So we have JP Morgan. Now if you've analyzed JP Morgan, you understand the company in which you're investing in, but you haven't looked at any of its peers. It's very easy to analyze its peers using Ticker Terminal. The first thing we want to do is, let's assume you know nothing about this industry. We want to analyze who the competitors actually are. Pop over to valuations. And in valuations, you'll see competitors. If we click on competitors, it'll show us all the different banks. Now, some of these banks are predominantly investment banks, such as Goldman Sachs, which is not a direct competitor to JP Morgan. So you got to have that little bit of background insight first before you get to this stage. Or you can dig a little bit deeper. What we want to do is we want to compare JP Morgan to its relative competitors. JP Morgan, Bank of America, Wells Fargo, and Citigroup. So now what we want to do is we want to analyze which bank is most profitable, which is generating the largest amount of return based on its shareholder equity. If we pop on over here to our financials, remember that the return on equity is a financial return metric. So we pop over here to ratios. In ratios, you can see we have return on equity. If we click on return on equity, it'll give us a chart long term. Ideally, we want this to be positive, of course. We want the company essentially to be performing quite well. A benchmark would be somewhere between 10 and 15% would be good to slightly excellent, depending on how far up that curve essentially you can go. Ideally, you want closer to 15% or above. What we can see here is that historically, over the past 15 years, JP Morgan has been performing consistently well, including during the global financial crisis. It was still generating a positive return on its equity. However, how profitable is it relative to its peers? How efficient is the management? Every company has a book value, a book value of shareholder equity. How much profit are they able to generate on top of that book value? That's what we're measuring. So we've got return on equity up here. We want to compare it to its peers. We have a look at Bank of America. We'll also have a look at Citigroup. And we'll also have a look at Wells Fargo. 3 banks, 3 competitors, with 3 very, very, very different return on equities. As you can see here, the best performing bank is JP Morgan. JP Morgan historically has been the most efficient in terms of generating returns on top of its equity. Fantastic performance long term, and almost every year outside of a couple of years in the mid-teens, we've seen JP Morgan as the most profitable bank. Wells Fargo has actually been falling downhill ever since 2014. And over the past couple of years, you're seeing Bank of America continue to perform on return on equity and Citigroup continue to, it's a little bit spotty, but grow out its return on equity. What this information tells us is the most consistent bank is JP Morgan. Absolutely. One of the better performing banks over the past 10 to 12 years has been Bank of America, and Citigroup look to be improving while Wells Fargo are going in the opposite direction. So right away we can take away our view. The most consistent and profitable is JP Morgan, and then we've got Bank of America, which has been improving over the past 10 years, and we've got Citigroup, which is improving under the new management. So we want to have a look now at valuations. What we can see is these banks are very, very profitable, generating returns on top of their book value. The difference between JP Morgan, trailing 12 months, is 16.86% in terms of return on equity versus something like Citigroup, which done just shy of 11%. 5% outperformance in terms of return on equity on the book value of shareholder equity. So now let's see what the market is willing to pay for that 5% of outperformance. When we pop over here to valuations, we'll see if we scroll down here, there should be a segment that says price to book value per share. We can also look at tangible book value per share if there's a lot of goodwill. But in this example, we're just going to look at book value. If we click on book value, again, what is book value? It's assets minus liabilities. And that is the book value of shareholder equity. So what are we paying for that equity if we purchased JP Morgan today versus something like Citigroup? Citigroup has almost 11% return on equity, whereas JP Morgan's a little bit more than 16%. So let's pull up JP Morgan, let's pull up Citigroup, and let's pull up Bank of America. And let's see which one would offer up the best value relative to its returns. And the one thing you can see is that there's a significant premium being paid today for a bank like JP Morgan. And what we can see is that there's a significant premium being paid today for a bank like JP Morgan relative to Citigroup. And in this environment, when you're looking at the return on equity, it might be a case that although it's not as profitable relative to the returns on those equities, based on the price we pay today, it might make more sense to actually own Citigroup relative to JP Morgan. And that's one way in which we can look at a company that's very sensitive to its assets, its return on those assets, and then the relative valuation. If you're interested, check out some other videos we have on profitability metrics, such as the return on assets. Thank you very much for your support and have a great day.